What better way to pay your monthly budget for Pop-Tarts than with these exceptional dividend stocks that are going to put money in your pocket every single month? Usually, stocks typically pay dividends every quarter, but that's not how your payments operate. Now, I will try to give you a brief overview of how to invest in this video, but it happened to me that we've never done a comprehensive tutorial on finding and investing in the best monthly dividend payers. If you look into these, you'll discover that there's more to these monthly dividend stocks than just their reliable cash flow. Because of their commitment to monthly dividends, these payers go above in their dedication to investor cash returns. Their management is laser-focused on cost control and efficiency. As a result of their constant focus on cash management and the dividend return it generates, these businesses exhibit less excessive spending and vanity projects than others. You have companies like Prospect Capital, which has returned $3.3 billion in dividends since its IPO in 2004. Or Realty Income ticker O, which has increased its dividend for 115 consecutive months and has paid its dividend every month for over 30 years. The most crucial thing to understand about monthly dividend stocks is that they're often in just a few different business models. Of the 60 monthly dividend payers and funds I monitor, 37 are in just 3 different business models, and the majority of the remainder are exchange-traded funds. I'll go into each of these individually, but they all have certain similarities and concerns you should be aware of. One of which is that the king of the return on these stocks will come from the dividend. These companies receive a special tax break if they distribute at least 90% of their income in the form of dividends to investors. This results in a great dividend yield, but also means that the company isn't reserving much for future share price growth. Share price growth varies from stock to stock, so don't count on monthly dividend payments to significantly increase your portfolio. These businesses are more sensitive than others to fluctuations in interest rates and the state of the economy. Since the business strategy for those real estate investment trusts and BDCs depends on interest rates and a booming economy, these stocks are prone to sudden drops in value when occurs. This isn't a deal breaker for the equities, but it's something you should be aware of in case the market declines. You need to know how to examine them since it is different from other companies. For instance, REITs and MLPs have so much depreciation that earnings is not a fair measure of income. This is more of a characteristic than a danger. Therefore, you must utilize cash flow rather than value measures like the PE ratio. So anyone who claims they wouldn't invest in that real estate stock due to the high PE ratio doesn't know what they're talking about. Let's look into monthly dividend stocks and how you get paid now that I've properly scared you with those possibilities. Basic monthly dividend stocks operate like any other stock. The board of directors announces a dividend each month and notifies investors that they must possess the shares on the day before the X payout date in order to receive the payment. The majority of corporations try to declare and pay their dividends at around the same time each month, since investors relied on that cash flow. The main difference between monthly dividend stocks is the nature of their businesses, which can have a significant impact on the stock. Business development corporations, often known as BDCs, act as banks for mid-sized businesses that are too big to borrow money from a regional bank but not big enough to go public. Consequently, BDCs make loans and occasionally invest in the firm. As a result, they are also very cyclical, seeing an increase in loan and investment defaults when the economy is weak. Real estate investment trusts, or REITs, hold property and provide rental income to investors. It's a fantastic way to include real estate in your portfolio without needing to come up with a significant down payment required for an investment. Although real estate is heavily leveraged, rising interest rates can hurt rates since they raise the cost of financing for the buildings. The third category of business in this oil corporations pay MLPs, which are master limited partnerships. a price to transport energy through processing facilities. Because a portion of their revenue comes from fees, they are often a little less vulnerable to swings in energy costs, although you will still see some volatility in the price of oil. The major disadvantage of MLPs is that you will get a new tax form every year, which makes filing a bit more challenging. Go to the stocks page on Yahoo Finance, click on this historical data, set this to display dividends only, and click Apply to view the ex-dividend date and the dividend payments for every stock. From there, you may explore past data across various time periods. I'll give my 3 best recommendations for investing in monthly dividend payers after listing my favorite monthly dividend funds and the monthly companies I buy. Don't only focus on the highest yields to start with. When looking at such closed-in funds or high-yield equities, investors get excited and dive right in. However, there is a trade-off between yield and stock appreciation, so it is advisable to stay away from either extreme. Therefore, the dividend funds and stocks I'll discuss next will strike a balance between capturing that cash flow and helping your portfolio grow. In light of this, make sure you review each stock's stock chart and dividend history, because too many high-yield stocks or monthly payers have actually done more damage to investors' portfolios than good. It is typical for the prices of these monthly dividend stocks to decline slightly, especially if the companies offer double-digit yields. But if that decline in price completely eliminates the dividend yields you are now earning, you are back where you started. Finally, make an investment in at least 1 or 2 funds that pay monthly dividends, like the ones I'll mention next. Not only will doing this provide you with that monthly cash flow, but it will also help spread out your risk and allow you to invest in other businesses and dividend stocks. There are more options available than simply the traditional suspects like BDCs, MLPs, and REITs. In this part, which I know some of you have already skipped, I'll feature some of my favorite monthly dividend funds. I know choosing stocks is the exciting part, but please take the time to go over the first section of this video, since you won't improve as an investor until you understand the dangers involved as well as what you should be searching for. In addition to paying a 13.52% yield, the Global X Super Dividend ETF is one of my favorite dividend investment funds, since it also offers you to companies that pay monthly dividends. The portfolio has one of the highest yields of any ETF and contains 100 of the highest dividend-paying equities in the world. Expense ratio is 0.58%. This is higher than others, but this one still has a lot going for it. The fund has good international and industry diversification, and I particularly appreciate the exposure to equities in other nations, which is something that most investors don't have. Since many of those stocks are in less expensive international firms, their average PE ratio is just 10, which is less than half that of US equities, giving you a strong value play and dividends. Let me know in the comments if you have any other questions about investing. Let's return to the video. Another well-liked dividend fund is the Invesco S&P 500 High Dividend Low Volatility ETF, with the ticker SPHD due to its lower risk and 3.78% yield. Since it combines the search of better yield with a reduced risk profile and low volatility, this is an excellent dividend stock ETF. The portfolio holds 50 stocks of historically reliable American businesses that offer significant dividend yields. I wanted to mix up between these 2 monthly dividend funds because it's a really interesting option for investors. It is a bit more focused in a few sectors, such as real estate, utilities, financials, and consumer staples, but those simply less volatile and economically sensitive ones. This 2-year chart shows that even while the SDIV provides a significantly bigger dividend, the SPHD more than makes up for it in price return. The SDIV dividend fund is currently up 0.8%, with the majority of that return coming from the fund's annual yield of 13.5%, which is already pretty impressive. The SPHD dividend fund, however, has actually generated a higher total return, with only a small portion of that coming from the dividend. This raises the question of whether your focus should be on overall return or monthly cash flow. Regardless, both of these funds are good choices since they will expose you to dividend equities other than your BDCs, REITs, and MLPs. Here, I also wanted to discuss two monthly dividend funds with you that are a little bit different. The first is the iShares Morningstar Multi-Asset Income Fund with its 4.21% yield, ticker IYLD. Since this product is a fund of funds and not one that invests directly in equities or bonds, it owns 10 income funds from various asset classes. As you can see, it invests in emerging market debt in addition to government bonds, real estate, preferred shares, and high-yield bonds. It also holds international equities. The target allocation for the fund is 60% in bonds, 20% in equities, and 20% in alternative income investments. It also has roughly 45% of the portfolio in foreign assets, demonstrating significant diversity by asset class as well as by other sectors and bonds, giving it a high level of safety even though it still retains sufficient assets and sectors for a solid total return. The iShares Preferred and Income Securities ETF, ticker PFF, with its 4.88% dividend, is another outstanding monthly dividend fund. Preferred shares are a unique class of equity that have additional rights to those of regular shares. The dividend yield on preference shares is fixed, and a payment is required before normal owners get any of their dividends. Additionally, these investments frequently have a substantially higher yield. For instance, Bank of America provides preferred stock with a dividend yield of between 6 and 7%, but its ordinary stock has a dividend yield of under 3%. But the best part is that preferred shares get some of the common stock's growing advantages. If the share price reaches a specific level, the majority of preferred stock is converted into those common shares. In essence, the corporation is arguing that investors should take advantage of this high dividend yield even if the stock price remains flat or rises. The average PE ratio of the PFF's 512 preferred securities is merely 9.5 times, which is again less than half the market average. Additionally, the fund's price is typically half as volatile as the stock market, supporting the notion of safety and cash flow. Due to the fact that the financial industry is the one that issues the majority of these preferred shares, the financial sector is rather strongly weighted, accounting for around 54% of the total. I adore these funds because they provide you exposure to various assets and dividend-paying firms outside of the monthly parish, but within an ETF that also pays out on a monthly basis. I decided to choose one stock from each of the three industry sectors for my top monthly dividend stocks: mortgage rates, REITs, and the BDC. With a 16% dividend yield, mortgage rate AGNC investment ticker AGNC comes top. $99 billion of the $103 billion in investments held by the agency are agency mortgage-backed securities. It effectively borrows money at those really low short-term rates, leverages it, and then invests in long-term mortgages. This is how it is able to transform a disparity between those low short-term rates and the longer-term rates of just 2% into a return of 9 or 10%. It hasn't been beautiful for AGNC lately, at 16.41 cents a share, and that implies the shares are trading beneath their book value, which is a very decent place to start in terms of value. Book value is basically the metric you want to use here with these mortgage loans. The net interest rate spread, which is the difference between the rate of interest on the investments and the short-term rates on which the corporation is borrowing, is one bright spot in this situation. Since the firm is hedged on a number of its goods and the spread has risen over the past year, it should be able to maintain its profitability going forward. Yet the mortgage market has been terrible this year, as increased interest rates prevent property purchasers, causing this and all the countries to plummet drastically. However, it has a good business strategy and will continue to generate that dividend yield with potential price growth. For BDC, Gladstone Investment Corporation, ticker GAIN, has a dividend yield of 7% that I like. And I like it because it takes a greater equity stake than most other BDCs, which is why I prefer GAIN here. Keeping in mind that such business development corporations primarily provide loans, the potential gain is limited to that interest rate. Contrary to standard BDCs, which seek for less than 10% stock in the firms they assist with, Gladstone's target investment is at 25% stocks and 75% debt. The risk associated with having a bigger shareholding may be higher, but the returns on those investments will also be higher. This is demonstrated by the fact that GAIN's historical return on equity has consistently outperformed the industry average. Even if near-term returns have decreased, the 5-year average ROE of 17% is still much higher than the group average and is more than 3 times the median ROE for that BDC group. Gladstone's present portfolio is divided over 28 firms in 14 industries, which provides a degree of diversification that should assist them maintain those returns even in a down economy. The performance of the shares has been so strong that additional special dividend payments have been made, increasing the cash return. Real Estate Investment Trust is listed under the STAG Industrial, ticker STAG, has achieved a 4.8% annual price return on top of that during the previous 5 years. So it's a strong combination of payouts and appreciation, even though the 5% dividend yield isn't as high as that of other REITs. STAG has 450 industrial and warehouse buildings spread throughout 38 states, totaling 91 million square feet. It's also one of my favorite property kinds. The retail property market has been decimated by the growth of e-commerce and online shopping. But because all those online purchases need to be stored someplace, warehouse demand has increased. In fact, e-commerce accounts for 43% of the STAG property portfolio. So with STAG, you gain exposure to a sector of the real estate industry that could continue to provide profits for decades to come, in addition to the dividend yield that is still over 3 times the market average. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.